So if, for example, in the next few months, the Fed would reach its interest rate goal and stop raising rates, according to this theory, and that's going to be the first test. According to this theory, the stock prices should fall.
We're going to discuss what the relationship is between interest rates and stock prices, and in doing so, figure out where stock markets may go following the Fed's monetary policy for the remainder of the year and into next year. Our next guest has some very interesting original research on this area. His name is Amir Goren, and he is a fund manager of the Economic Defense Fund. Prior to launching his own fund, Amir was an economist at General Motors and obtained his PhD in economics at UC Irvine, and earlier his Master of Science at MIT. Welcome to the show, Amir. Good to host you.
Thank you very much for having me, David.
So we're going to be talking about your research and also a little bit about the direction of the auto industry, given your experience working at General Motors. First, explain to us why it is that this year, while interest rates have been heading up, with the Fed funds rate going up and the 10-year yield hitting 17-year highs, stock markets have continued to rally. Normally, you would think that with interest rates going up, stock markets would come down. Why didn't that happen this year?
So I think, first of all, it's an important question and does require explanation, because all of the economic theories predict that higher interest rates would lead to a slowdown and to a decline in stock prices. The traditional or classical economics predict that higher interest rate would lead to a drop in consumption in favor of savings. And then there is a very famous theory by Bernanke and others that is called the financial accelerator theory. And the very easy to understand way of this theory is, if the stock market was 20% down today, would retail sales be up? And finally, there's a theory that says that if the risk-free interest rate, the treasury rate, is high enough, then money should flow from stocks to bonds. And all of these things didn't really happen. And so that's where my theory comes in. And I call my theory the financial decelerator. And it works through the option market. Basically, when interest rate increase, the call options become more, the prices go up, and put options, the price go down. And that forces option dealers to buy stocks to hedge themselves and pushes the stock prices up. So the flows or the gradual change of interest rate, according to this theory, causes stock prices to go up. So there are two separate forces. There is the level. According to all the other theories, a high level of interest rate is supposed to be negative for stocks and for the economy. And what I'm saying is that as long as there is an expectation for the interest rate to continue increasing, it has a contradicting effect on the stock market.
Okay. Now, let's just look at history. So in 2007, at the end of the period, the 10-year yield was around 4.5%. Throughout the recession of 2008 and 2009, the interest rate continued to fall. So we saw a positive correlation between the yield and the stock market. Is that in line, first of all, with your theory that correlation should have happened?
So the theory, there are two basic testable predictions. The first testable prediction is what happens when the Fed stops hiking. And according to this theory, this supposedly positive news for the market would actually trigger the accelerator. So basically, the accelerator would be working without any opposition from the decelerator. And that would be the point when stocks would be free to decline. So if, for example, in the next few months, the Fed would reach its interest rate goal and stop raising rates, according to this theory, and that's going to be the first test. According to this theory, the stock prices should fall. Yeah. So the second prediction or testable prediction is what happens, like you said, when the Fed reduces rates. And according to this theory, as long as there is an expectation for lower and lower rates, the stock market should continue to decline. And only when the interest rate reaches its final destination, the accelerator or the rest of the economic forces would allow stock prices to start rising again. And you could have seen that in previous cycles, I think, as well, like you mentioned.
Isn't another explanation simply that should the Federal Reserve cut rates next year, it would be because of some sort of economic decline or a recession, and typically stocks do poorly during a recession anyway, so it's not really, the stocks wouldn't do poorly because of the interest rate decline per se, it's doing badly because there's a recession, right? How would you respond to that?
Yes, and what I'm saying is that there's a difference in the manner of lowering rates. What I'm saying is that there's going to be a difference if the Fed reduces rates suddenly in one or two swoops, or whether they're going to reduce rates gradually. What I'm saying that if I'm correct, reducing gradually will exacerbate the stock price decline, while reducing suddenly would allow stocks to start rebounding. So what I'm saying is that there's a difference between the level and between the trajectory. A negative trajectory in the rates is according to this theory, will cause a continuation of a drop in stock prices.
Amir, what is your projection then for what the Fed may do next year? We're guessing, of course, but based on the data, based on economic analysis, based on what Jerome Powell has said, do you think they'll cut suddenly or gradually?
So it looks like they're going to cut gradually. I think they have some concerns about inflation, and understandably so. So I think we're going to have a perfect test for the theory. This also ties to what happened this week with inflation and oil prices recently. As you know, the Fed ignored oil when it was inflationary. They said that there's nothing they can do about oil, so they didn't take it into consideration. They look at the core CPI. But when the oil price declined and contributed to a decline of inflation, the Fed actually took credit for the decline in inflation and attributed it to successful monetary policy. So that's why they kind of reduced their rate hikes, because inflation went down. But the reality was that the decline in the oil price was because of SPR releases, and those pushed the oil price down. And now when the SPR releases are over, you see that the price of oil has spiked again. So I think now they're going to be in a problem, because now they will be forced to raise rates again. And at the same time, the high oil price by itself is also a type of tightening, right? Because all the costs, both of the consumers and of the producers, are going to be higher. So we saw the PPI increasing, and we saw the CPI increasing.
The markets are, well, I'm looking at the CME Fed Watch tool. The futures market is predicting no hike by next week. So the Fed's meeting next week. A good chance of a hike by the end of the year, and then reaching a terminal rate of between 550 to 575 basis points in the Fed funds rate. So one more hike and that's it, is what the market is predicting. What do you think?
I think that the Fed reduced their pace of hikes because of political pressure. So basically, if there's no inflation, they have no justification to continue hiking. But if inflation starts rising again, they will have all the justification to increase rates again. And so I think that they will wait to see if this is a one time or if this continues going forward. Based on the price of oil that is way ahead of them and the inflation, it will not be a once-off. And as a result of that, they would be forced to hike in November and possibly also continue after that. So if the effect of the SPR release is going to be reversed, then the contribution of lower oil prices to lower inflation is going to be reduced as well, and that would require the Fed to act.
What about if, let's say, unemployment all of a sudden goes way up, even though inflation is still high or higher than 2%? What would they do in that situation?
Well, at some point, the pain or the political pressure of unemployment would force them to react, but we are way away from that, right? We are, below 4%, and they would react when it's 6 and above to the unemployment. So I don't think it's something to consider right now. So we would need to see stocks crash, the economy get into a recession. Only then we will see unemployment spike, and then they will be forced to reduce rates.
Does your theory talk about timing, meaning which comes first, a crash in the markets or a fall in the interest rates?
So usually the stop of the hikes correlates with the decline in stocks, right? So that happened in previous cycles. When the Fed stops hiking, that's when the stock market drops, and that typically happens at the beginning of a recession. So that would be the sequence of events, and the reduction in rates only comes in the later part of the recession when the unemployment rate spikes.
But it's possible that there would be some geopolitical or macro event that could push down stock markets, and then you're saying that the Fed would have to react to that by cutting rates as well?
No. The Fed doesn't react to the stock market. The Fed reacts to inflation and to unemployment.
So I've heard that theory by other economists, which is that the Fed unofficially has three mandates, which is unemployment, inflation, and also if the stock markets fall, they're probably under pressure by the financial community to do something about that. Is that true?
I don't believe so. I think that they look at the stock market and the financial system as a whole as a conduit for the policy. And you might have heard Jay Powell refer to that a few times, saying that the way they believe the interest rate works is through the financial conditions. And that's exactly the theory that I mentioned before by Bernanke and others, that is called the financial accelerator theory. And according to that theory, the increase in rates is supposed to push stock prices down and accelerate the entrance into a recession or into a slowdown. And we've seen this year that it hasn't worked that well, and that's why I introduced the decelerator theory.
Do you think that then if the Fed funds rate will go up once, maybe two more times by the end of the year, does that mean then logically that stocks will continue to go higher until the end of the year as well?
Yes, that's very possible, unless the oil price. So I think that the rise in the oil price is also a form of tightening by itself. So that's another force that is operating in the economy right now. And we had this huge release from the Strategic Petroleum Reserve that kind of kicked the can down the road in terms of the effect of the war in Ukraine and the shortages that were created over a few decades in the oil industry. And we're now getting this effect back into play. So I think that combined with higher rates might slow down the economy.
When do you think they will cut rates?
So that depends how aggressive they are right now, right? If they were aggressive enough earlier in the year, then I would agree with the March estimate. Right now, it looks like everything is going to be pushed forward. And if they're not aggressive enough in curbing inflation, then this could be prolonged.
So does that mean then, according to your theory and according to your expectations for the Fed, we will not see a significant equity market correction for maybe the next 2 quarters? Can we make that assessment?
I think that if the Fed, let's say, hikes one more time and signals next week that they're going to stop after that, then we could very may well see a stock market decline, because that's basically the trigger that I'm waiting for the stop of the hikes.
So it could come sooner than 2 quarters. It just depends on the Fed's messaging next week.
Right.
Now, does your model or theory make any predictions as to how significant a correction could be, given whether or not it's a gradual decrease in rates or a sudden decrease in rates? Is there a magnitude component to this theory?
Not really. As you know, based on the Warren Buffett indicator, stocks are very, very overvalued. And so we're in some kind of a bubble, unprecedented bubble. And so we should see a correction at least to the trend or to the average. What I'm saying is that if they reduce gradually, if they reduce rates gradually, it might overshoot downwards. So that could extend the fall of stock prices beyond the average into even lower territory. That's basically.
Just to push back on your theory, if someone were to say to you, well, Amir, logically, if rates fall, even if it's gradual, would that not signal perhaps more consumer confidence, meaning that with lower interest rates, people can have the ability to borrow money more, or perhaps get a mortgage again, or feel comfortable getting another mortgage, or
Right.
perhaps just spend more money? Wouldn't we see aggregate demand increase with falling interest rates?
Yeah, that's the simple economic logic, but we've seen that it hasn't worked so well over the last year. So I'm kind of adding another layer on top of that and saying that there's a difference in the how, in the trajectory. So what I'm saying is that there is going to be a difference between a quick drop and a gradual drop. A quick drop would allow the normal economic forces to operate. A gradual drop would have an additional contradicting force, which is the decelerator, and that would make matters worse.
Do you have an expectation as to how dramatically their cut would be if that were to come? So I'll give you something that I've heard from somebody I spoke with. An economist told me that if you look at history, the Fed has historically cut by up to 500 basis points during a recession. That's just what happened in the past. So his prediction is that it's possible rates will go all the way down to zero. Now, that's one extreme view. What's your view?
So my view is that they would start gradually, like they did last time around. They will start to reduce gradually until they see that things are bad enough, and then they will drop suddenly to the zero.
And when that sudden drop happens, is that when we can expect a stock market rebound?
That would be my expectation. So that would be the trigger that I would be looking for to enter long.
So you brought up earlier that oil has been spiking. That's been a big contributor to why the headline CPI has been rising as well. Core CPI ex food and energy has been falling though, but it's still above 4%. So let's take a look at the crude oil price. WTI, as we speak today, is above $90 a barrel. What is your expectation going forward?
So I hedged my position on oil explorers. waiting for a little bit of a pullback at this point. I think that from what I've seen, China started to sell some oil from its strategic petroleum reserve, and so that would probably, give some balancing effect on the oil market. But long term, I expect the oil price to continue higher, and probably for the next 10 years because of the structural issues.
Are you then assuming that inflation will be sticky, or are there other forces that might bring inflation down?
So only a recession, I think, would be able to bring inflation down. Yes.
Let's talk about the auto sector. So as I mentioned at the beginning, you do have experience working as an economist at General Motors, so you do have a deep knowledge of where the industry is headed. Tell us what the priorities of the American auto industry are right now.
Right. So the industry is following kind of a barbell strategy, where on one hand they are selling and profiting from very large cars such as trucks and SUVs, and those are vehicles that consume a lot of gasoline. And so that part of the business is going to be negatively affected by the rise in oil price and gas prices. So that's not a good sign for the from the industry, and especially for the American big three. The other part of the barbell is electric vehicles. And in that space, I think it's safe to assume that the expectations of these companies entering the EV space was to duplicate the success of Tesla, and believing that the cost of batteries would continue to decline into the future. But because of the sudden demand from all the car companies, both in the US and abroad, the demand for battery metals such as lithium and others spiked and increased the cost of those batteries. So right now, all the players in the space are racing to secure sources and supply of these metals, and that's going to make it very difficult for them to make any money in electric vehicles because of the costs of those vehicles.
So you were an economist at GM in 2021 to 2022. During that time, was there an interest or a priority in shifting to an entirely EV fleet for GM? Is that what they were trying to do last year?
Oh yeah, absolutely. All of the car companies made commitments to transition to 100% EV fleet by 2035, I believe. So the intent was to replace all the old vehicles and to design them out by designing in EV versions into the fleet.
Well,
So
you said that they're not going to be profitable with current EV production, right? So how are they going to achieve that objective in the next 12 years then, if they're not profitable with EVs?
So I think that they're going to face some difficulty meeting this commitment, especially doing so profitably, because of the high costs of battery metals and the limited production capacity of those metals. And so I think if oil price is going to remain elevated, it's going to complicate the gas side of the business, the SUV and trucks, and the sudden entrance of all these companies at the same time without any preparation of supply chain of these battery metals is going to make EVs difficult to scale up in a profitable manner.
Well, Tesla has recorded a very good year in terms of profits. What is Tesla doing that perhaps other car companies like GM are probably not?
So I think Tesla, well, obviously Tesla was ahead of the curve in everything, right? They invented this category, and they were ahead of the curve in terms of securing supply of metals. They have their own battery supply chain. So it's not a coincidence that Tesla is the leader of this space. They seem to be the ones that know what they're doing. The other companies were entering based on collaborations and partnerships with other companies such as LG, BYD, and other companies for the production and supply of the batteries without much visibility into the metal space. So they were not battery producers initially. They were supposed to make the batteries in collaborations with other more established battery producing firms. And so the visibility from these large car makers into the mining space of lithium and the other metals was limited initially. I believe that at this point they're already up to date on the problems and the supply shortages, and we've seen actually GM try to acquire a company in South America for the supply of the lithium.
Okay, so you expect more vertical integration that way, more acquisitions of miners from the automakers?
Yeah, absolutely. We just saw Albemarle acquire a lithium company in Australia called Liontown, and there is probably going to be more M&A both in the battery space and in the oil space. So I think, in the oil space, there would be M&A of explorers that have oil in the ground, that have discoveries and can turn into producing wells by more established companies. And in the lithium space and other metals, there are going to be M&A as well, yeah.
Well, the zero carbon emissions guidelines by 2035, I don't think they state specifically that cars have to be electric. Do you think that maybe hydrogen is a solution?
Yeah, absolutely. I think that Japan seems to be going all in on hydrogen. Obviously, they have limitations in terms of the oil and gas capability, and they have a lot of water around them. And they're pursuing a strategy of using nuclear to produce both the electricity and the hydrogen simultaneously. That's called red hydrogen. And so once they're able to establish a working prototype or environment where hydrogen can be used, that would be an important test whether that can be duplicated to other places in the world.
Finally, I want to comment on some recent news with the auto sector. The UAW strikes, the United Auto Workers Union. As of midnight today, they officially went on strike against the big three automakers. They walked off a number of plants for GM and Ford. They did not reach an agreement with the automakers on pay. Their demands, analysts are speculating, cannot be met because they're demanding much higher pay. And this is interesting because the markets overall today are down, whereas GM and Ford stocks are up. So I don't know why the markets are perceiving this as good news. From somebody who has worked at GM as an economist, let's say you were there today, would you be concerned about this strike potentially bankrupting the company?
No, I don't think that's it has to be that far. I think that what happened with the UAW is that they saw the spiking profits of GM that were a result of COVID, basically, right? So we had shortages, and what happened was that car companies were able to increase their prices to very high levels because of the shortage. And so people were willing to pay any price to just get into a car. And so the profit on the individual car was much higher than normal. And the UAW concluded from that the workers are being taken the advantage of. So I think that's where the strikes comes from. But I think that there's a lot of pressure from the used car markets at the moment, a lot of repossessions, and that's going to affect car prices as a whole. So I don't see a repetition of the last couple of years in the car market. So I think if the UAW get what they want, it would be really bad for the company and bad for the workers eventually. So I think they should probably compromise on some more modest demands.
So the headlines or the concerns I'm hearing that this is the end of the auto sector, that's potentially too dramatic, according to you?
Yeah, not because I'm very bearish on the auto market, but not because of the UAW, because of the strategy that is being pursued.
Okay. On that note, then, what is your strategy for your current investments, the Economic Defense Fund? Tell us about what you're doing right now.
So I do mostly macro. I try to capture the big trends, and right now the big trends, as far as I can see, are bullish on commodities such as uranium and oil. So I'm long these two sectors. But other than that, I am very bearish on the market as a whole. So I'm short the market.
Where can we learn more about you and your work?
So you can visit my website, the Economic Defense Fund, or you can follow me on Substack, where I publish a newsletter, and it's called Economic Defense.
Okay. Amir, it's a pleasure hosting you today. Welcome to the show. Thank you very much for joining us.
Thank you, David. Bye-bye.
Yeah, and thank you for watching. Don't forget to subscribe and like this video.